Hi everyone, this is Nick Peters from realestatespreadsheets.com. In this video, I'm excited to walk you through the dashboard of our rental property analysis spreadsheet. The dashboard is where everything happens. It's basically the control center where you'll input your key assumptions that will flow through the other tabs of the spreadsheet and drive the entire analysis. Before we dive into its 5 key sections, I want to take a moment to explain the color code used throughout the spreadsheet. Understanding the approach will help you use the spreadsheet more efficiently. You'll notice cells are typically one of 3 colors. Red and blue cells are input cells specifically designed for you to enter your assumptions. Red cells are essential, which means they absolutely need to be filled in for the spreadsheet to work properly. So don't leave these blank. Blue cells, on the other hand, don't necessarily require an input and can be left blank if they don't apply to your situation. All other cells in the spreadsheet, whether they're white, gray, or yellow, are calculated fields. These cells are locked by default, and you won't be able to modify them or enter any value. This is normal because they contain formulas used by the model to run calculations. Another nice feature I want to mention is the navigation menu located at the top of the tab. You can easily navigate through the different sections instead of endlessly scrolling. So keep that in mind when using the spreadsheet. It will save you time. Now, let's dive into each of the 5 sections of the dashboard. First section covers your acquisition assumptions, which are divided into multiple areas. Starting on the left side, you will find the property information box. This is where you can enter details about the property you're analyzing, things like the address, size, number of bedrooms and bathrooms. While this information isn't mandatory and doesn't impact the analysis, it will appear in various reports throughout the spreadsheet. I recommend filling out these fields if you plan on using or printing the reports, plus it makes it easier to keep track of previous analyses. If you're using this spreadsheet outside of the US, know that you can easily change the currency throughout the spreadsheet by adjusting the model currency. Similarly, you can choose between square feet and square meter for the unit of measure. Now, let's enter some information about our property. Next, we have the purchase assumptions. This is where you'll enter your property purchase price, expected repair costs, closing costs, and any other costs associated with the acquisition process itself. Holding costs typically refer to costs you'll incur before renting the property. For instance, if your property needs renovation that might take a couple of months, the operating expenses like utilities and insurance during this period are considered holding costs. Let's work through an example together. We'll enter a purchase price of $350,000 and assume repair costs of around $25,000. We'll also include $10,000 for various purchasing costs and $1,000 for utilities and miscellaneous expenses during renovation. You can see the spreadsheet automatically calculates the total acquisition costs at $386,000. Next to each cost line, you'll see a checkbox. These let you decide if you want to finance that cost with debt when checked or cash when left unchecked. You'll notice the mortgage size automatically adjusts accordingly in the next section. For our example, let's assume repair costs are also financed with debt, so we'll check that box. Just below the acquisition costs, you'll find the after repair value, or ARV. This represents your property's value after improvements and renovations. The spreadsheet uses this figure to calculate certain financial ratios like cap rate, adjusted cap rate, and your property's value at sale. For our example, let's use an ARV of $375,000, which represents the sum of our purchase price and expected renovation costs. If you're unsure about your property's ARV, a good starting point is to assume it equals the purchase price plus any renovation costs. If you're not renovating at all, then your ARV will simply equal your purchase price at closing. Moving down to timing assumptions, this is where you'll enter your property's purchase date and expected holding period. The spreadsheet can forecast up to 30 years of operations, but you can run your analysis with fewer years if you plan to sell earlier. Let's enter a purchase date and set our holding period to 30 years. You'll see the spreadsheet automatically calculates your expected sale date along with what we call the optimal sale date. This tells you which year you should sell to maximize your internal rate of return. Keep in mind this analysis only works with a 30-year holding period, and you'll need to enter your operating assumptions in the next sections before that date can be calculated. We'll discuss this in more detail in our video about understanding and interpreting return on investment. The last area of the acquisition assumptions section focuses on your property's value over time. One of the best things about real estate investing is that on average real estate appreciates over time. It's important to account for this potential increase in value to get an accurate view of your investment, especially for longer holding periods. In the spreadsheet, you can estimate your property's value over time in two different ways. The first approach uses an appreciation rate or growth rate. This assumes your property's value increases by a specific percentage each year. The spreadsheet lets you distinguish between inflation rate and any appreciation above inflation. For instance, if you're in a hot market where real estate prices have increased significantly and are expected to continue rising, you might want to enter an additional growth rate on top of your inflation assumption. In more stable markets, you might want to be conservative and not assume any additional appreciation. Because the future is uncertain, you should always estimate these figures conservatively. For our example, we'll assume inflation will remain around 2% per year, and our local market is booming, benefiting from an additional 1% growth rate, giving us a total growth rate of 3% annually. If you want to enter specific growth rates for each forecasted year, rather than one flat rate for the entire period, you can check the Custom Annual Rate box. This feature activates a new input line in the Forecast tab where you can enter your growth rate assumptions year by year. This feature becomes particularly useful if you expect significant changes or fluctuations in property value in the future. For instance, if you plan on completely rehabbing the property in year 3, it's reasonable to assume its value will increase after that year. In our example, we'll keep things simple and continue using a flat rate. The other way to assess your property's value over time is by using a capitalization ratio or cap rate. This approach determines your property's value by dividing its net operating income at the time of sale by a capitalization rate. Although this method is more common in commercial real estate than residential, it's still valuable for understanding what other investors might pay for your asset based on its income generation potential. For this example, we'll stick with the appreciation method. The final assumption in this section covers selling costs. Enter this figure as a percentage of the property value at sale. For our walkthrough, we'll use 7% as a reasonable estimate. Based on all these assumptions, the net proceeds are estimated at $846,508 when we sell in year 30. Now let's move on to the financing assumptions section. This is where you'll enter all your mortgage details. You can enter your down payment as a percentage. Let's use 20%, which is typical in the US. Then enter your loan interest rate, let's say 5%, and your loan term, which is usually between 20 and 30 years in the US. We'll use 30 years for this example. If you have an interest-only period, you can specify the number of years this will apply. We won't include any interest-only period in our case. In the middle, under Other Assumptions, you can enter your assumptions for closing costs and private mortgage insurance, also called PMI. Loan insurance is typically required by conventional mortgage lenders when homebuyers put down less than 20% of the purchase price. For reference, at the time of this recording, the average annual PMI premium typically ranges from 0.55% to 2.25% of the original loan amount each year until the loan-to-value ratio reaches a certain threshold, usually 80%. You can enter this threshold in the cell below. Let's put in some assumptions for our example. We'll enter 2% as our mortgage closing costs, a PMI of 1%, and a maximum loan-to-value for PMI cancellation of 80%. You might notice the model calculates a PMI payment even though our threshold is set at 80% and our down payment is 20%. This happens because in the acquisition costs section, we told the model to finance renovation costs with debt. As a result, our total debt amount as a percentage of property value, or loan-to-value, is above the 80% threshold, which triggers PMI. If we decided to finance the renovation with cash instead, our LTV would drop to 80%, eliminating the PMI requirement. The next cell down is the reinvestment rate, which we use to calculate a financial indicator called MERR, or Modified Internal Rate of Return. The indicator provides an alternative to the traditional IRR by allowing any positive cash flows generated by an investment over the holding period to be reinvested at the reinvestment rate instead of the project's internal rate of return. For the purpose of this walkthrough, we'll use 10%. If you'd like more information about this ratio and other financial ratios, please check out our video dedicated to calculating KPIs and financial ratios. Based on all these assumptions, the model automatically calculates your mortgage payment and loan insurance payment, if applicable, both monthly and annually. Now looking on the right side, you'll find what we call a uses and sources table. This summarizes your different funding sources and how the funds will be used. Notice that this table always shows the same total on each side since any expense must be matched with a funding source, whether it's cash or debt. In our example, our project is expected to cost a total amount of $392,100, of which $305,000 will be financed with a mortgage and $87,100 with cash on hand. The third section covers your refinancing assumptions. If you plan on refinancing your property in the future, perhaps after rehabbing it as part of a buy, rehab, rent, refinance, and repeat investment strategy, this is where you'll enter your financing parameters. Start by selecting Yes to activate the refinancing feature, then enter the details of your new mortgage. This includes the year you expect to refinance and all the details of the new loan. Note that you can enter the size of the new mortgage either as a specific dollar amount or as a percentage of loan-to-value, or LTV. The other details in the refinancing section mirror what we covered in the financing section, including closing costs, loan insurance, and the maximum LTV for PMI cancellation. Just like before, a uses and sources table will show you the flow of funds expected on your refinancing date. For this example, we're not going to assume any future refinancing. Let's move on to the fourth section, where we enter the operating assumptions for our property. The first step is to select which module to use. If you're using the Pro version of the spreadsheet, you can choose between the simple and advanced modules. The advanced module offers more detailed per unit operating assumptions, making it ideal for larger multifamily investments. When you select this module, you'll need to enter your operating assumptions in the Multi-Units tab instead of the dashboard. If you're using the light or advanced version of the spreadsheet, this module won't be available, so you'll need to use the simple module by default. Once you've selected your module, you can start entering your property's expected rental income in subsection 1. You can enter income for up to 5 units, plus another source of income, which is usually used for revenue generated from garages, laundry rooms, storage units, or similar amenities. If you have more than 5 units, we recommend using the Pro version of our spreadsheet, which is specifically designed for larger investments. So let's enter some figures here. Let's enter an expected rental income of $3,500 per month, as well as $50 in additional monthly income. After entering your rental income, you can fill out the operating expenses. You can enter up to 18 different types of expenses. 9 of these are fixed expenses, meaning they're calculated as a dollar amount, and 9 are variable expenses, calculated as a percentage of your gross scheduled income. The spreadsheet comes pre-populated with some of the most common expense types, but you can edit these fields as needed. So let's enter the expected operating expenses of our property. Utilities are usually paid by the tenant for long-term rentals, so we won't enter any here. We'll add, however, $50 for garbage removal, $150 for HOAs, $100 for property insurance, and $250 for property tax. Fixed expenses will obviously vary with each property. Don't simply use the same figures I'm showing here and try to research what the actual operating expenses of your property are or will be. Similarly, variable operating expenses will also depend on your property's type, age, and location. However, some rules of thumb are easier to come up with. For instance, it's usually fair to allocate around 7% of your gross scheduled income to repairs and maintenance. Same thing with property management, which usually ranges from 7% to 10% of your rent. These figures can, however, vary depending on your location, so do your research beforehand. Your analysis will only be as good as your input, so make sure you enter realistic assumptions here. In our example, we'll assume that the property is self-managed, so we won't enter any percentage for property management. And don't forget to enter your assumption for capital expenditure. While it's not technically an operating expense, this is something beginner investors often overlook, even though these expenses can be substantial and significantly impact your investment's profitability. Let's enter 7% for this example. Another useful feature is the rule of thumb. If you're running a quick analysis and don't want to enter all your property's expected expenses, you can activate this feature. The spreadsheet will then automatically assume that operating expenses equal the percentage of gross scheduled income you've selected in that cell. But for this walkthrough, I won't use this feature. Now, let's look at the other operating assumptions. Here you can enter several key parameters. The first one is your vacancy rate, which you can calculate either as a percentage of rent or as a number of weeks or months per year. The spreadsheet gives you the option to keep this assumption flat across your forecast or enter a custom rate for each forecasted year. To use custom rates, simply select Custom next to the parameter. You'll then need to enter your assumptions directly in the Forecast tab for each projected year. Let's assume our vacancy rate is approximately 3 weeks per year here. Similarly, you can set your assumptions for annual rent increases, other income increases, and both fixed and variable expense increases. For each of these, you have the option to enter either a flat rate or custom rates. Note that for variable expenses and capital expenditures, selecting flat rate means the spreadsheet will use the list of variable expenses you entered previously and maintain that percentage of gross scheduled income throughout the forecast period. So let's enter 2% flat as our assumption for both annual rent increase, other income, and fixed expenses. We'll also keep variable expenses and capital expenditure flat, meaning that they'll continue to represent 7% of our gross scheduled income over time. Finally, we reach the summary results section. This is where you'll see the results of your analysis. The section displays your expected cash flow for year one, along with many other key performance indicators, including capitalization rate, cash-on-cash return, cash-out date, internal rate of return, and more. Note that you can select whether your cap rate and adjusted cap rate are calculated using your purchase price or your ARV by using the drop-down menu located above each indicator. In our example, the property is expected to represent a capitalization rate of 8.75% using the purchase price and a cash-on-cash return of 5.74%. Over time, the rental is also expected to generate a 9.4% unlevered IRR and a 14.3% levered IRR. For detailed information about these financial indicators, check out our video or blog posts where we discuss these KPIs in depth. The last feature I would like to discuss is the maximum offering price tool. Here you can enter your target return metrics, and the spreadsheet will automatically calculate the maximum purchase price needed to achieve them based on the assumptions you entered in the previous sections. Remember that for this tool to work properly, you need to have entered all the necessary information we've discussed in this video. If key inputs are missing, the spreadsheet won't be able to run properly. So let's give it a try and enter our target return for each metric. We'll enter 10% for cap rate, 8% for cash-on-cash return, $450 for positive cash flow in year one, 15% for IRR, and 12.5% for MRR. By clicking on the Run button, the spreadsheet will automatically calculate the property price you need to pay to reach these targets. In our example, the purchase price will vary between $306,000 and $343,000 approximately. And that covers everything in the dashboard. You now know how to use 90% of the spreadsheet. While our other videos will describe the remaining tabs in more detail, remember that most of your work happens right here in the dashboard. Once you've mastered this tab, you've essentially mastered the entire spreadsheet. I hope this video has been helpful. As always, if you have any questions, please don't hesitate to reach out. We would be more than happy to assist. Best of luck with your investment analysis, and I'll see you in the next video.